You've been lied to your entire life about what it means to be financially secure.
That pile of cash you're meticulously hoarding in your savings account isn't a safety net. It's a melting ice cube, and every second it sits there, it gets smaller.
While you think you're being responsible, you're actually watching your hard-earned wealth evaporate into thin air.
The traditional advice to save for a rainy day is a relic of an era that no longer exists.
In today's economy, staying still is the fastest way to fall behind.
You feel a sense of pride when you see that balance grow, but that feeling is a psychological trap.
Your bank is not your friend. It's a warehouse that charges you for the privilege of losing value. Every day you leave your money in a standard account, you are participating in a slow-motion financial suicide. The purchasing power of your dollar is under a constant, invisible attack.
If you don't understand the forces working against your savings, you will never be truly wealthy.
This isn't about how much, it's about how much of that value you actually keep.
Society rewards the movers, the builders, and the investors, not the hoarders.
Your fear of losing money is actually what is causing you to lose it.
We need to dismantle your current financial worldview and rebuild it from the ground up. The middle class is obsessed with saving, while the wealthy are obsessed with cash flow. Saving is a defensive play, and you cannot win a game by only playing defense. You are literally working hours of your life for a currency that is programmed to lose worth.
Let's look at the cold, hard numbers that the banking system doesn't want you to calculate. The math is simple, brutal, and entirely stacked against the casual saver.
Welcome to the reality of the silent thief, inflation. Imagine you have $100 today. In a year, that same $100 still looks the same.
But when you go to the grocery store, that same bill buys fewer eggs, less bread, and smaller portions.
The nominal value stays at 100, but the real value, the purchasing power, has shriveled.
Inflation is currently averaging significantly higher than the interest rate your bank offers.
If inflation is 5% and your bank pays you 0.1%, you are losing 4.9% of your wealth every single year.
That is a guaranteed loss. It's not a risk, it's a mathematical certainty. Think of it as a hidden tax on your discipline and your hard work.
Governments around the world are printing more money, which dilutes the value of every dollar you have saved. When the supply of money increases faster than the goods available, prices must go up. This is why your parents bought a house for $50,000 that now costs $500,000. The house didn't necessarily get 10 times better, your money just got 10 times weaker.
Now, let's look at a small sapling in a pot. This represents compounding. Compounding interest is the eighth wonder of the world when it works for you.
But compounding inflation is the silent killer when you choose to just save cash. Over 20 years, even a low 3% inflation rate will cut the value of your savings nearly in half. You aren't just losing a little bit, you are losing the ability to retire. Look at this physical gold coin. For centuries, it has held its purchasing power. An ounce of gold bought a fine suit in 1920, and it buys a fine suit today. But the cash value of that suit has gone from $20 to $2,000. If you saved the $20 in 1920, today you couldn't even buy a pair of socks. This is the depreciation curve of paper currency. It is a race to the bottom. Your bank account is a boat with a hole in it, and you are trying to bail water with a teaspoon. You need to stop bailing and start moving toward a vessel that actually sails. To do that, we must address the psychological traps that keep you stuck in the saving cycle. The first trap is loss aversion. Humans are wired to fear losing what they have more than they desire to gain. You see your bank balance stay the same and you feel safe because you don't see the numbers go down. If you invested in the stock market and it dropped 5%, you'd panic. But inflation dropping your value 5% is invisible. You are more comfortable with a slow,
guaranteed loss than a volatile, potential gain.
This is a cognitive bias that keeps you poor. You are prioritizing comfort over math.
The second trap is anchoring. You anchor your worth to the nominal number in your app.
You think, I have $50,000. I am doing great.
But you aren't factoring in that $50,000 only buys what $40,000 bought 5 years ago.
Then there is lifestyle inflation. As you earn more, you spend more to keep up appearances. You buy a better car, a bigger TV, and more expensive meals, thinking you've earned it. But these are all depreciating assets. They lose value the moment you take them home. You are trading your time and your future for objects that end up in a landfill.
You are following the crowd, and the crowd is broke. The average person has less than $1,000 in savings. The crowd believes that saving is the finish line. In reality, it's just the starting block.
If you do what everyone else does, you will get what everyone else gets. Financial anxiety.
Let's break this cycle by looking at the velocity of money.
Wealthy people don't let their money sit still. They keep it moving into assets.
Imagine two people, Sam the saver and Ivy the investor.
Sam saves $1,000 a month in a bank account for 30 years at 1% interest.
Ivy invests $1,000 a month in a diversified index fund for 30 years at 7% average return.
After 30 years, Sam has about $420,000. Sounds good, right?
But Ivy has over $1.2 million. The difference is staggering.
Ivy didn't work 3 times harder than Sam. Her money just worked 3 times harder for her.
Sam stayed safe and ended up with a third of the wealth, while inflation ate half of his purchasing power.
Ivy took a calculated risk and achieved true financial freedom.
This is why saving is the slowest way to get rich, but the fastest way to stay poor.
Let's look at a real-world case study, the 1970s inflation crisis.
Those who held cash saw their life savings lose 50% of their value in a decade.
Those who held real estate or stocks saw their assets rise in price along with inflation.
They didn't just survive, they thrived because they owned things that the world needed. Now, let's build your escape plan from the saver's trap.
Step 1, redefine your emergency fund. Keep only 3 to 6 months of expenses in cash.
Anything beyond that is an idle asset that is costing you money every day. Step 2, automate your investments. Don't rely on your willpower to save.
Willpower is a finite resource. A direct deposit into an index fund is infinite.
Step 3, buy productive assets. These are things that produce value or income.
This could be low-cost index funds, rental properties, or even your own business.
Step 4, practice mindful spending. Audit your recurring subscriptions and mindless purchases.
Every dollar you don't waste on a status symbol is a soldier you can send to war for your freedom.
Step 5, focus on your earning capacity. The best asset you have is your ability to generate income. Invest in your skills, your network, and your health. These are inflation-proof. No one can print more of your expertise. It is a unique and scarce resource.
Step 6, understand asset allocation. Don't put all your eggs in one basket. A mix of equities, bonds, and real estate creates a shield against economic storms.
The goal isn't to be rich today. It's to be wealthy forever.
Rich is a bank balance. Wealth is the freedom to choose how you spend your time.
When you only save, you are a slave to the currency. When you invest, the currency is your slave.
Stop looking at the price of things and start looking at the value.
Price is what you pay. Value is what you get.
The banking system thrives on your compliance and your financial illiteracy.
They want you to keep your money in their vaults so they can lend it out at 10 times the rate they pay you.
They are using your savings to get rich while you get poorer.
It's time to stop being their fuel.
This is a rigged game, but you finally have the rule book.
Your ancestors saved gold because gold was money. Today, your money is just a digital entry in a ledger.
It can be created out of nothing by a central bank. Don't hoard something that can be created out of nothing.
Hoard things that are scarce. Hoard land, hoard knowledge, hoard shares of great companies.
Every time you choose to save instead of invest, you are betting against human progress.
Investing is a bet that the future will be better than the present, and history is on your side.
You have the power to change your trajectory starting today.
It won't be easy. It requires a shift in your identity from a saver to an owner.
Owners profit from inflation. Savers are destroyed by it.
Which one do you want to be when the next economic wave hits?
The system isn't going to change for you. You have to change for the system.
Stop being the person who works for money. Start being the person who money works for. Your future self is either going to thank you for your courage or curse you for your caution. Don't let your hard-earned life force evaporate in a 0.1% savings account.
Take control. Open that brokerage account. Buy that first share. Start that side business.
The information you've learned today is your most valuable asset, but only if you use it. Understanding this rigged game is the first step to winning it.
If you found this analytical breakdown helpful, you are already ahead of 99% of the population.
But the world of wealth psychology is deep, and the traps are everywhere.
To keep learning how to navigate this system and protect your future, subscribe and join our community of builders.
Your financial survival depends on your ability to stay informed and stay active.
Don't just save money. Build wealth. I'll see you in the next deep